in line, probably in the band of about 5 to 10 basis points, given the kind of sell-off that we have already seen right now. The 10-year government security benchmark is almost at 6.8%. The good news here is that foreign institutional investors have been continuous buyers not only in the equity markets but also in the bond markets. January year to date 2017, we have seen almost 1 lakh crores of inflows by FIIs both in the equity and the fixed income markets. In fact, in the first 2 working days of April alone, we've seen approximately 10,000 crores of FII flows into the bond markets. This, we believe, will keep the yield rise under check with incremental buying coming in from foreign investors as also some investors in the domestic segment. What should be the outlook going forward and the strategies that investors should focus on? In this kind of a scenario, we have been quoting for quite some time that short-term or credit accrual-based strategies seem to be the best fit for an investor seeking exposure into fixed income. Ultra short-term kind of strategies also would probably be a better suited investment avenue over liquid funds where the yields are at abysmally low levels, and we believe will continue to remain that way going forward. Should one look at duration funds like gilt and bond even right now? Well, we believe that these funds come in with inherent increased volatility given the longer nature of the duration that they have, and therefore a buy on dips could be a potent strategy, probably as a tail end allocation to your fixed income portfolio. To conclude, we believe that the domestic variables are broadly under control with no imminent negatives in the offing. Crude has been under control. Inflation has been fairly orderly. It remains to be seen how the global factors pan out, which will obviously shape the future course of the monetary policy in India. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello friends. As part of our continuous endeavor to be closer to our investors in order to share our market views on a real-time basis, we have started with a series of actions that we will have with you on a monthly basis. As part of the first series, I'll be sharing the debt views, broadly the views that we have for the financial year FY16. We have seen a meaningful reduction in rates across various tenors of around 100 to 125 basis points in the last 1 year. The fall in rates that we have seen in the last 1 year was obviously aided by a lowering of inflation and inflationary expectations, a lowering of the current account deficit numbers, sharp disinflationary forces that we saw in terms of commodity prices, as well as the fact that government's adherence to fiscal discipline has driven a lot of comfort in this system, both from an inflationary expectation perspective as well as from a RBI monetary management perspective. As a result, we have seen the Reserve Bank of India already having cut rates twice over since January of this calendar year. We do expect the Reserve Bank of India to cut rates by an additional 50 basis points in the next 6 to 9 months. This will be broadly aided by 2 primary reasons. One, we will continue to see these disinflationary pressures continue. As the government pursues on its path of fiscal consolidation, a lot of expenditure essentially that we have seen in the earlier years will be rationalized. Subsidies will be better targeted, and we will also see a lot more supply side responses from the government in terms of tackling inflation. And second, we are going to continue to see globally disinflationary pressures as far as commodity prices are concerned. So both from an inflation perspective as well as from a fiscal discipline perspective, we believe that the RBI will have the required comfort that will open up space for at least 50 basis points of further rate cuts from here on. What will aid the transmission of these rate cuts into the economy is also the significantly improved liquidity conditions that we see right now. Over the last 12 to 18 months, liquidity conditions in the system have improved significantly because of continued healthy FX flows, because of reducing pressures from currency in circulation, and also because we are seeing an improvement in financial savings. As we go along, we will continue to see a robust FX inflow environment, and also the fact that the government on its path of fiscal consolidation will also ensure that there is an impetus, or there is a support provided to financial savings. Now that is the reason why we will see liquidity conditions improving. So better liquidity conditions along with a rate cut environment will essentially not only mean that yields come down, but also that the curve starts to bull steepen. And a bullish steepening of the yield curve has ramifications for products across the yield curve. From a Reliance Mutual Fund perspective, we believe that this is going to help in terms of performance of not only long duration products like the dynamic bond fund and the income fund, but we also think that it may help in terms of performance of intermediate duration products much more. For example, products like the short-term bond fund, the ultra-short-term funds, as well as the corporate bond fund, vis-a-vis what we have seen in the last 12 to 24 months. Hence, we think that investors who are looking at various options of investments into debt products, depending on their risk return profile and depending on their investment tenors, can decide between these intermediate duration products as well as long duration products like the dynamic bond fund for investments that will most likely deliver good returns over the next 12 to 24 months. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
What is a mutual fund and what are the benefits of investing in a mutual fund? Your financial requirements are likely to grow over time, and even though your income may grow at a steady pace, inflation will take its toll. Traditional forms of investments such as simple bank fixed deposits or investments in gold may not help you realize your dreams and goals. How do you derive the maximum benefit from surplus funds? How will your dream of buying a car, going on a holiday, or buying a house be realized? Mutual funds might be the answer. What is a mutual fund? A mutual fund is a collective investment tool that pools together money from many investors. These funds are then invested by a professional manager in various companies after. Mutual funds allow an individual to take part in the stock market. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Friends, the financial year 2015 has been a great year for equity investors. As the country heralds into a new dawn under the new leadership of Prime Minister Modi, and as the macroeconomic factors turn positive, we have also seen decent returns being made by equity investors in Indian equity markets. As we move forward to the new financial year, we move ahead with a lot of optimism as far as the economy as well as the equity markets are concerned. Our three pillars of optimism continue to be very, very dynamic and very vibrant. The first one is the macroeconomic factors turning positive. The second is the non-linear events, which is a fall in the crude prices, as well as a very robust governance, as well as focus on growth led by infrastructure, railways, defense, and so on and so forth. The third pillar is the earnings growth, and though the March quarter earnings are expected to be tepid, we expect in the next 3-4 years earnings to be quite robust. As we move forward, in the near term also, our view is that the markets might continue to show strength. The triggers for the near term obviously are passing of a few important bills which are likely in this month in the session of the parliament. We also expect the earnings upgrade as far as the country is concerned, and we believe that it's a matter of time before India's ratings are improved. And the most important thing, as we mentioned earlier, is the earnings growth. We also believe that the government spending, which was rather timid in the last financial year, should pick up pace as we enter the new financial year. With the fall in the crude prices, as also expectation of a slightly more robust taxation collection, we expect government spending led by infrastructure, railways, roads, defense to pick up meaningfully. This, along with a falling interest rate environment, should ensure that earnings growth trajectory comes back on track. We believe that that would be the biggest trigger as far as the equity markets are concerned. Thus, in short, from an Indian perspective, things look to be quite positive. From a global perspective,
the financial advisory business is rapidly evolving from offering just sales-based advice to advice-based sales of financial products. Advice that ensures customers can avail of better performing financial products that offer higher returns and enhanced security. Advice that empowers financial advisors to offer quality services is based on an understanding of numerous factors that influence the performance of financial products. Understanding that is gathered through a deeper understanding and solid analytics. Shaping tomorrow's financial planners. Independent Financial Associates Network, IFAN, is a B2B distribution platform for financial products that supports its associates to enhance their advisory and client services with the help of innovative technology and unbiased research. Established in 2005, IFAN possesses over 75 years of combined work experience in the financial industry. IFAN was founded with a vision to establish itself as a reliable partner for business growth and higher profitability that empowers financial advisors in India with a comprehensive range of investment products and services by being a one point of contact for all financial product and asset classes. IFAN offers a web-based B2B financial products and services platform where financial advisors and distributors can gain access to services like basket of products, research, financial planning, e-Nivesh, online wrap solutions, portfolio monitoring, CRM, commission management, training, financial planning, and trailer monitoring. It serves as an efficient, low-cost, plug-and-play model for advisors to scale up their business in a standardized manner. IFAN also offers professional back-office services for product research, marketing, and legal and compliance. IFAN provides efficient online access to its clients, enabling them to monitor all investments under one roof. Manufacturers can access IFAN's widespread professional associate network across the country. The greatest benefit that an associate of IFAN would hold is with IFAN's assistance, he would be in a position to grow his business both in quality and quantity. IFAN's research-based B2B platform offers various asset classes, covering mutual funds, debt, equity, real estate, home loan, LAP, and LAS to over 50,000 clients through a 1,000 plus dedicated associates network in 7 cities in India. The company has been ranked in top 50 distributors in India amongst over 90,000 distributors in mutual fund. IFAN also ranks amongst the top 5 distributors in company fixed deposit mobilization. Being a large institute and aggregator has an advantage to negotiate with financial product providers and thus offer higher short-term and long revenue to its associates. This also helps associates sustain their skilled manpower, thereby helping them increase their client base. As an associate starts increasing his network, he will have the potential to earn higher revenues across product classes. IFAN partners include a company that enables IFAs to gain greater efficiency and the ability to tap into economies of scale and at the same time help them deliver better service performance for their clients without increasing the cost. IFAN has taken the initiative to lead the change and facilitate a paradigm shift from the current sales-based advice to a more effective, advice-based sales model in the financial services sector. Ifan.
और बेटा सेटल हो गए नई जॉब में? सैलरी आ रही है ना टाइम पर?
हाँ अंकल, देखिए ना, मैंने पहली सैलरी से ये फोन लिया था। नेक्स्ट मंथ की सैलरी से पूरा वार्डरोब चेंज, और सितंबर में ये वॉच खुद को बर्थडे गिफ्ट की थी।
और तुमने अभी तक गाड़ी नहीं ली? बैंकॉक घूमने नहीं गए?
अभी इतने पैसे बचते ही कहाँ हैं? बट अगले साल ये सब प्लान में है।
और शादी?
रिंकी के घर में तो अभी पता भी नहीं है, पर उससे पहले घर लेना पड़ेगा। रिंकी के पापा ना।
लेकिन अगर अगले साल बैंकॉक, कार, तब तक ये फोन भी पुराना हो जाएगा। फिर एक और बर्थडे, एक और गिफ्ट, और तब तक रिंकी के पापा को पता चल गया तो ना आया घर, ना हुई शादी। तो क्या घड़ी होगी, कपड़े होंगे, शायद कार भी होगी, उसमें ही तुम्हारा दोस्त एयरपोर्ट छोड़ देगा, तुम बैंकॉक चले जाना।
अंकल, आप तो डरा रहे हो।
ना बता रहा हूँ, क्योंकि तुम्हें शादी से पहले घर लेना है और इसके लिए पैसे बचाने पड़ेंगे। न सिर्फ बचाने पड़ेंगे बल्कि इन्वेस्ट करने पड़ेंगे। आज मेरे पास सीमा भी है, घर भी, कार भी, और ये घड़ी मैंने लंदन से ली थी।
अंकल, 2-3 हजार बचा भी लिए तो उससे क्या घर आएगा?
2-3 हजार कम होते हैं क्या? शुरू तो करो।
बट इन्वेस्ट कहाँ करूँ?
तुम शेयर्स, बॉन्ड्स, डिबेंचर्स, गोल्ड, इन सब में इन्वेस्ट करो।
अंकल, इन सब के बारे में तो मुझे कुछ भी नहीं पता।
इन सब में इन्वेस्ट करने का आसान तरीका है म्यूचुअल फंड्स।
मतलब?
तुम्हारे और मेरे जैसे लोग जब म्यूचुअल फंड में इन्वेस्ट करते हैं, उस पैसे को फंड हाउस स्कीम के इन्वेस्टमेंट ऑब्जेक्टिव के मुताबिक अलग अलग कंपनी के शेयर्स, बॉन्ड्स, डिबेंचर्स वगैरह वगैरह में इन्वेस्ट करते हैं।
बट अंकल, ये सेफ तो है?
म्यूचुअल फंड स्कीम्स को प्रोफेशनल्स मैनेज करते हैं। इनकी कोशिश ही यही रहती है कि आपकी रिस्क कम करें और अच्छा रिटर्न दिला सकें।
तो अंकल, देखा जाएगा। लगा।
अरे हीरो, यहाँ बात मरने मारने की नहीं है, इन्वेस्टमेंट की है। तो हमेशा सोच समझकर, और जब रिंकी के पापा को पता चलेगा ना कि तुम ये सब कर रहे हो, अरे खुद तुम्हारे घर आएंगे बात करने के लिए।
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
Considerable research. Mutual funds allow an individual to take part in the stock market without having to monitor its movements on a regular basis. The fund manager takes your money and invests in a wide range of stocks and fixed income investments or debt. With the technique of diversification, it is possible to counter market fluctuations and minimize risk. So, if a particular group of stocks in a portfolio does not do too well at a given time, there is a possibility that the loss is balanced or minimized by better performing stocks in that portfolio. Once invested, you are given units in the fund based on invested. These units are easily redeemable, which means that you can liquidate these units simply and quickly. Net asset value, or NAV, represents the value of one unit investment after all fund management fees are paid. NAV multiplied by the number of units gives you the value of your investment. You can invest a lump sum or through a systematic investment plan. In summary, the benefits of investing in a mutual fund are
much funds. These funds are also income funds, and their aim is to provide easy preservation of capital and moderate income. These schemes invest exclusively in safer short-term instruments such as treasury bills, certificates of deposit, commercial paper and CBLO, government securities, etc. Returns on these schemes do not fluctuate much compared to other funds. These funds are appropriate for corporate and individual investors as a means to park their surplus funds for short periods of time. Gilt funds. These funds invest exclusively in government securities. Government securities have no default risk. NAVs of these schemes also fluctuate due to the change in interest rates and other economic factors, as is the case with income or debt-oriented schemes. Mutual fund investments are subject to market risks. Read all scheme-related documents and information carefully before investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
How convenient is it to invest in a mutual fund scheme? Investors can contact their financial advisor for necessary information and application forms. Forms can be deposited at the collection centers through the distributors who provide such services. Investors can also visit the AMC's sales office, registrars and transfer agents or investor service centers and deposit duly filled application forms. Most AMCs today also offer an online transaction platform which enables investors to complete their investment on the internet without any physical application forms. Investors should note that there are cut-off times for transacting in any mutual fund scheme, and the applicable NAV is dependent on the time at which the transaction is recorded. For example, if on January 1st you invest in DSP BlackRock Equity Fund and submit the application form before 3 p.m., which is the cut-off time for DSP BlackRock Equity Fund, the applicable NAV will be as of January 1st. If, however, this transaction is recorded after 3 p.m., the applicable NAV will be that of January 2nd. Mutual fund investments are subject to market risks. Read all scheme-related documents and information carefully before investing. How convenient is it to invest in a mutual fund scheme? Investors can contact their financial advisor for necessary information and application forms. Forms can be deposited at the collection centers through the distributors who provide such services. Investors can visit the AMC's sales office, registrars and transfer agents. January 2nd. Mutual fund investments are subject to market risks. Read all scheme-related documents and information carefully before investing. What are the different types of mutual fund schemes? There are several ways to categorize mutual fund schemes. Let's check out a few of them. First of all, schemes can either be classified as open-ended schemes or closed-ended schemes. What is an open-ended fund or scheme? An open-ended fund or scheme means that it's open for business on all business days. You can invest or withdraw your money on all business days. Liquidity is the key feature of open-ended schemes. And what are close-ended funds or schemes? Close-ended funds or schemes have a stipulated maturity period. Example, 3 months, 6 months, a year or more. Unlike the open-ended funds that's open for business on all business days, close-ended funds are open for purchase only during the initial launch and for redemption at specified periods of time, either immediately post-launch or later, depending on when the AMC specifies. Mutual fund schemes can be classified according to the investment objective. Such schemes may be open-ended or close-ended schemes, as described earlier. Let's take a look at some variations. Equity funds. The aim of growth funds is to provide capital appreciation over a medium to long-term period. These funds invest in equity shares of companies and therefore offer the investor the potential for growth. Such schemes invest a major amount in equities. Equity schemes are suitable for investors having a long-term outlook, seeking appreciation over a period of time. Balanced funds. The aim of balanced funds is to provide the benefits of investing in both equities as well as debt securities in the proportion indicated in their offer documents. These are appropriate for those investors who are looking for growth without taking too much risk. These funds are also affected because of fluctuations in share prices in the stock markets. However, NAVs of such funds are likely to be less volatile compared to pure equity funds. Index funds replicate the portfolio of a particular market index, such as the BSE Sensex, S&P Nifty, etc. This makes tracking your investments simple and easy to understand. NAVs of such schemes would rise or fall in accordance with the rise or fall in the index, though not exactly by the same percentage due to some factors known as tracking error in technical terms. Necessary disclosures in this regard are made in the offer document of the mutual fund scheme. Income or bond funds. Income funds invest in debt securities such as bonds, corporate debentures, government securities, and money market instruments. Such funds are less risky compared to equity schemes. These funds are not affected by fluctuations in the equity markets. However, opportunities of capital appreciation are also limited in such funds. Income funds are generally preferred by individuals with a low risk profile. Money market or liquid fund. These funds are also income funds, and their aim is to provide easy liquidity, preservation of capital, and moderate income. These schemes invest exclusively in safer short-term instruments such as treasury bills, certificates of deposit, commercial paper and CBLO, government securities, etc. Returns on these schemes do not fluctuate much compared to other funds. These funds are appropriate for corporate and individual investors as a means to park their surplus funds for short periods of time. Gilt funds. These funds invest exclusively in government securities. Government securities have no default risk. NAVs of these schemes also fluctuate due to the change in interest rates and other economic factors, as is the case with income or debt-oriented schemes. Mutual fund investments are subject to market risks. Read all scheme-related documents and information carefully before investing.
Interestingly, for all three of you, you have two sets of consumers in that sense. You have an intermediary who is also your consumer or customer or stakeholder in that sense, and an end consumer who is your policyholder, and in your case, the investor. So how do you kind of, have this engaging possibility with the digital mediums in all three of them, all two of them? Because earlier you had to only look at, I'm taking care of my distributor, he's taking care of the end consumer, so it's all his headache, I've transferred it. I've got an agent and he's going to do it. That's the way it would have been for you. But now that the, route is direct to you and consumer has that much choice.
There once was a poet who fell upon such hard times that he was no longer able to feed his family. So he decided to set out for the palace and appeal to the generosity of the king. 4 on the 3rd, 8 on the 4th square, and so on. By the time they came to the 10th square, they had to place 512 grains of rice. By the 20th square, the number swelled to 5,24,288.